Welcome to the deep dive. Today, we're really digging into one specific company, Sky Gold Diamonds Ltd. We've got a whole stack of material here, their investor presentation, a con call transcript, credit rating report, analyst coverage, quite a bit.
That's right. And our job today is basically to unpack all of this for you. We want to figure out what really makes this business tick, how they manage this incredible growth recently, what their plans are looking ahead.
And also get into the key risks and opportunities that these documents highlight.
Exactly. Consider this your shortcut to getting up to speed on Sky Gold, but importantly, based only on what's in these specific sources we have in front of us.
Yeah, and honestly, looking through this stuff, some things really stand out. I mean, how does a B2B jewelry maker actually double its revenue? More than double, in fact. What's so different about their model?
It is quite the story, isn't it? The numbers alone are something else. Okay, so let's start unpacking what the source material tells us.
Sounds good. Let's start with the basics then.
Mm.
According to these documents, who exactly is Sky Gold Diamonds Ltd?
Okay, so at its core, the sources describe Sky Gold as a B2B player, business to business. They manufacture jewelry, and their big focus is on lightweight gold pieces.
Right, lightweight gold.
Yeah.
And the analysis mentions this job work model quite a lot. What exactly is that, and why is it, so central?
Yeah, that's a really crucial piece. A big part of their operation, maybe the defining part, uses what they refer to as advanced gold.
Right.
Basically, this means the client, the big retailer they're making jewelry for, actually gives them the gold.
Ah, okay. So the customer provides the main raw material.
Pretty much. And that's huge because it drastically cuts down the amount of money Sky Gold needs to have tied up in gold inventory themselves. Gold is expensive, right?
Right.
So this is a big deal for capital efficiency.
Right. That makes immediate sense. Much less capital intensive if you don't have to buy all the gold up front.
Exactly. And the sources also point out a strategic shift they've been making. They're moving sort of from just churning out generic designs to what they call design-led co-creation.
Design-led co-creation sounds fancy.
Well, it means they're working much more closely with big retailers, developing unique designs together. The documents specifically name some big partners they've brought on board. Think Carrot Lane, Malabar, Reliance.
Wow, Malabar, Reliance,
Yeah.
those are major players. How does that design focus help them? Beyond just making nice jewelry, I mean.
Well, the analysis suggests it's key for a couple of big reasons. One, it helps their profit margins. Proprietary designs, things you can't get elsewhere, can command better pricing.
Makes sense.
And two, it embeds them deeper with these large partners. They get access to huge distribution networks through companies like Reliance or Malabar, better margins and better market access.
Okay, so besides the core 22K lightweight gold, are they branching out product-wise?
They are. The sources show they're expanding. They've added 18K gold. They're also moving into diamonds, both lab-grown and natural ones. And there was a recent acquisition mentioned that added bangles to their lineup, too.
Interesting. And geography. Is this mostly an India story, or are they selling elsewhere?
Predominantly India, yeah, based on the FY25 numbers cited here, about 92% domestic revenue. But the sources really emphasize the export side. It's only about 8% right now, but it's growing really fast. That rapid export growth is definitely something the analysis picks up on.
Okay, so we've got a handle on who they are, their model, their customers. Let's look under the hood a bit. How do they actually do all this? The sources talk about some specific competitive advantages.
Yeah, this is where their operations get interesting. The analysis points to significantly lower operating costs, like really low compared to peers. The source puts Sky Gold's cost at about 1.5% of revenue.
1.5%. How does that compare?
Well, they estimate peers are running closer to 3%. So yeah, basically half the operating cost.
Half. Wow. How do they manage that according to the analysis?
The sources seem to link it back to that job work model partly, but also to scalable systems they've put in place. They also highlight a much faster turnaround time. We're talking 15 to 25 days for orders versus maybe 30 to 45 days for competitors cited in the material.
Faster and cheaper. That's a potent combination in manufacturing.
Definitely a strong operational edge. And those exclusive client relationships you asked about earlier, that ties back to the design-led thing.
Ah, the co-creation.
Exactly. If you're developing unique designs with a client like Carrot Lane, they're less likely to just switch suppliers, right? It creates stickiness.
Makes sense. Does technology play a role in their efficiency? I think I saw something about an ERP system.
Yes, absolutely. The sources mention they use an ERP system. It helps manage operations as they scale and apparently leads to high productivity per employee. Another goal for the ERP mentioned in the material is improving control over gold loss during manufacturing.
Gold loss, like tiny bits disappearing in the process.
Yeah, it happens. They state it's currently around 0.5%. Doesn't sound like much, but with the volumes they handle, even small improvements there can really add up to the bottom line.
Right, okay. Let's get to the numbers everyone's probably waiting for. How did all this translate into financial performance, especially that massive growth figure?
Okay, yeah, the numbers. This is where the sources paint a really dramatic picture. FY25 was, well, explosive. Consolidated figures show revenue hitting 3,548 crore. That's up a massive 103% year over year.
Doubled, more than doubled revenue in 1 year. That's just wild for a manufacturing company of this size. What about profits? Did they keep pace?
Profits grew even faster, actually.
Mhm.
That profit after tax came in at 132.7 crore. That soared 228% year over year.
228%.
Yep. And EBITDA was also very strong, 196.4 crore, up 154%. And it seems like the momentum carried through the year. The Q4 FY25 numbers cited show revenue of 1,058 crore, which itself was up 106% from the previous year's Q4.
Incredible growth trajectory. But was it just volume pushing those numbers, or did their actual profitability per sale improve too?
Margins improved too. The patent margin for the full year FY25 hit 3.7%, and the company guidance mentioned in the source aims for 4.5% by FY27. Gross margins also ticked up from 6.0% in FY24 to 7.1% in FY25. Q4 was even stronger at 7.8%.
So the shift to design-led work and the scale seems to be paying off in profitability too.
That's certainly what the analysis suggests, yeah. Better margins per sale.
Okay, but with that kind of insane revenue growth, you always have to ask about cash flow. Doubling your business usually means tying up a lot of cash in inventory, waiting for payments. What do the sources say about their cash situation?
And that's a really critical point the analysis digs into. For FY25, their operating cash flow was actually negative, minus 273 crore.
Negative. Despite soaring profits, how come?
The material is pretty clear on the why. It was primarily driven by what they call WC buildup, working capital buildup, specifically big increases in inventory and accounts receivable.
Money owed by customers.
Exactly. And part of that, the sources explain, was due to the timing of Akshaya Tritiya. It's a major gold buying festival, and it fell late in their fiscal year. So lots of sales happened, but the cash hadn't come in by year end.
Timing. So a big sales surge right before the books closed meant a lot of money was still outstanding.
That seems to be the main explanation provided. Inventory also built up ahead of that expected demand.
Okay, so if operations were consuming cash, how did they fund that gap and the growth itself?
Well, looking at the financing cash flow section in the reports, that was strongly positive. 427 crore came in. This was mainly from issuing fresh equity plus some additional debt.
So they raised money.
Yes. And because the operating cash flow was negative, it means their free cash flow was also negative for FY25. But the company guidance reported in the analysis targets positive free cash flow by FY27.
Turning cash flow positive by FY27 is key then. That negative OCF in the fundraising must have changed the look of their balance sheet quite a bit.
It definitely did. The balance sheet reflects that big capital injection. Net worth jumped significantly from around 244 crore in FY24 to over 683 crore in FY25.
Big jump in equity. What about debt?
Debt also went up. Total debt stands around 604.9 crore according to the sources. But here's the interesting part. Because the equity infusion was so large, their gearing ratio debt relative to equity actually improved. It came down to about 1.1x.
So the new equity more than offset the new debt in terms of their capital structure ratio.
Exactly. The balance sheet got stronger in that sense, even with more absolute debt.
How much capital did they actually raise in total?
The sources mention a recent QIP qualified institutional placement that brought in Evero 270 crore, and that was on top of about 128 crore raised earlier from UHNI's, ultra high net worth individuals and the promoters themselves. So a pretty substantial chunk of new capital.
Nearly 400 crore in total then. And given the negative OCF, it sounds like a lot of that went straight into funding that working capital, build up the inventory and receivables.
That seems to be a major use, yes. And managing that working capital is highlighted as a huge focus area in the analysis. At the end of FY25, inventory was almost 400 crore, receivables over 450 crore, still reflecting that Akshaya Tritiya timing effect.
That's a lot tied up. What are their plans for getting that under control?
They track working capital days. The sources say it peaked at 72 days. Currently, it's around 60. The target mentioned is to bring that down to 55 days by FY27. Getting those days down is absolutely critical if they want to hit that positive operating cash flow target.
Right. Unlock that cash faster. What else are they planning to spend on besides working capital? Any big investments in future growth? CapEx.
Oh, yeah. There's a clear CapEx plan outlined. About 100 crore is earmarked, mostly for building a huge new manufacturing facility.
A new facility. How big?
The goal cited is a 4.5x increase in their manufacturing capacity by FY28. That's massive scaling. They're also apparently working on freeing up some locked capital by replacing fixed deposits held as collateral with land assets instead.
A 4.5 times capacity increase. That points to some incredibly ambitious growth plans beyond just managing working capital. Let's dive into those future targets.
Ambitious is definitely the word. The core plan is scaling capacity from 1 ton per month currently up to 4.5 tons per month. And that new 5.4 lakh square foot facility is where that's supposed to happen. That scale is really the foundation for everything else they're targeting.
And you need customers to fill that capacity. Are they still signing up those big retail partners?
Seems like it. The analysis lists quite a few significant additions just in FY25 Reliance, Aditya Birla, Carrot Lane, PN Gaggill, Pothies, Vega, a whole list. Continuing to land these big organized players is crucial for their plan.
Especially given the concentration risk, which maybe we can touch on later.
Exactly. But yes, onboarding is key. And they're also looking to evolve the type of work they do.
How so? Moving beyond the basic job work.
Well, pushing more towards that advanced gold model where the client provides the gold. The target mention is for that model to be 10% of revenue by FY27 and then a much bigger chunk, 30% by FY30.
So becoming even more asset light as they scale up.
That seems to be the strategy. Make the growth less capital intensive.
And you mentioned exports earlier, that fast-growing segment. What's the target there?
Exports are clearly a major pillar of the growth plan. They tripled to 300 crore in FY25, right? The target is for exports to hit 20% of total revenue by FY27.
20%. That's a big jump from 8%. How are they planning to achieve that?
The sources mention some concrete steps. Opening offices in Dubai, for example, and appointing a distributor in Malaysia who has apparently already placed a significant order, 200 kilograms per month. Details like that make the export plan feel a bit more tangible.
Definitely. What about those newer product lines like diamonds?
They're targeting growth there too. The diamond segment under their Sky brand is aiming for about 4% of revenue by FY27. That's up from roughly 1% now. And that acquisition, Ghana N Gold, it wasn't just about adding bangles. That business apparently already runs on a 100% advanced gold model, which fits perfectly with Sky Gold's overall strategy.
Okay, so let's try and put all these pieces together. Massive capacity expansion, landing more big clients, pushing the advanced gold model, huge export growth targets, expanding into diamonds and bangles. What's the overall revenue number they're aiming for, according to the analysis?
The headline target laid out in the source material is, well, aggressive. They're aiming for 7,600 crore in revenue by FY27.
7,600 crore. That's basically doubling the business again from the FY25 base in just 2 years.
Exactly. Doubling, then doubling again. It's a huge ambition.
But growth like that fast, always comes with risks, right? Potential roadblocks. What does the source material flag as the main concerns?
Well, first there are the general industry risks,
Yeah.
Gold prices are volatile. Regulations like import duties can change. The global economy matters. And it's a very fragmented, competitive market, which the analysis notes can limit your pricing power.
Standard industry stuff. What about risks specific to Sky Gold's plan and how they operate?
Yeah, the company-specific risks highlighted are really important for understanding the potential challenges. One big one is customer concentration.
Yes, you mentioned that. Still heavily reliant on a few big clients.
According to the sources, yes. The top 10 clients make up over 70% of their revenue currently. So even as they add new big names, losing just 1 or 2 major partners could still have a really significant impact. That dependency is a key risk flagged.
Okay, high concentration. What else?
The working capital intensity we talked about. Funding this kind of rapid growth, even with the advanced gold model helping, still requires a lot of cash. The analysis points out their working capital utilization has been high, near 92% in FY24, and there's a gap between their current assets and their available bank funding limits. It links directly back to that negative OCF challenge.
So managing cash and funding remains critical, and their reliance on gold medal loans. Is that seen as a risk?
Yes, GMLs, as they're called. It's a common financing tool in the industry, using gold as collateral. But the sources note it makes them sensitive to interest rate changes. And interestingly, their plan is actually to increase their reliance on Gmail funding, aiming for 85% of working capital needs by FY 26-27.
Increasing exposure to interest rate risk, then.
Potentially, yes. It's a trade-off they seem to be making.
It really sounds like flawless execution across the board is going to be absolutely essential. Managing cash, scaling up production, handling exports.
Exactly. The analysis boils much of it down to execution risk. Can they actually roll out that ERP system effectively across much larger operations? Can they get receivables under control and bring those working capital days down consistently? Can they ramp up that huge new factory smoothly? Can they manage the logistics and complexities of rapidly growing exports? These are all significant operational hurdles mentioned.
What about the people side, governance, as they grow so fast?
Yeah. The sources know it's still largely a promoter-led company. But the analysis views the recent hiring of experienced professionals quite positively, bringing in a dedicated CFO, head of sales, head of operations. That's seen as a good sign, a step towards strengthening governance and building a team capable of managing this much bigger, more complex business.
Okay, so we've covered the business model, the explosive financials, the very ambitious future plans, and the significant risks involved. How does the analysis wrap this all up? How do they value the company, putting a price tag on all this?
Right, valuation. Based on the source's current market price at the time, around $393, the analysis lays out a few metrics. They calculate a forward price-to-earnings ratio, looking out to FY27 earnings estimates of about 18 times.
18 like FY27 PE.
Okay, and an EV to EBITDA multiple for FY27 of roughly 13.2 times. One point they note is the price-to-book value looks quite high for FY25, around 11x, but that's expected to come down significantly to maybe 4.8x by FY27 as all that new equity boosts the book value number.
And did the analysis give a specific target price?
Yes, the Nuvama report cited gives a target price of $550. That suggested about a 40% potential upside from the CMP when the report was written. Their rationale was based on applying a 25 times multiple to their FY27 earnings per share estimate of 21.8.
25 times future earnings. How does that compare to others in the jewelry space, according to the sources?
The comparison points highlighted are that Sky Gold shows a higher return on equity around 28%. It currently has lower leverage than many peers mention, and critically, it has a much, much faster projected growth rate.
So the premium multiple is justified by the superior growth and potentially better returns.
That seems to be the argument presented. They also mention the PEG ratio, price to earnings to growth.
Right.
Based on the projected growth rate from FY25 to FY27, the sources calculate a PEG ratio of less than 1, which, is often interpreted as suggesting a stock might be undervalued relative to its expected earnings growth.
Okay, so let's try and pull this all together then. What's the final verdict from this deep dive into the source material?
I think the strong message coming from the analysis is that Sky Gold seems to be at a really significant inflection point. They've laid out plans that, if executed, point towards very aggressive growth, both in India and increasingly internationally.
Right. And the key strengths identified seem to be that incredible growth momentum driven by winning big clients and that export push.
Yeah, plus their efficient operating model, that lean cost structure, those improving margins.
The shift towards the more asset-light, advanced gold model, and maybe the recent steps to professionalize the management team.
Definitely. On the flip side, the main weaknesses or risks highlighted are clearly that customer concentration.
Still relying heavily on a few big names.
The negative operating cash flow in FY25, showing how much cash this growth consumes.
And just the sheer execution risk. Pulling off such a rapid, multi-pronged expansion is inherently challenging.
Absolutely. So the overall conclusion from the analysis seems to be that the valuation, while maybe not looking cheap on past numbers, could be seen as reasonable if you believe in their ability to deliver on that massive scale-up potential and the expected improvements in efficiency, like getting cash flow positive and boosting returns further.
Makes sense. It's priced for a lot of future success.
It is. And according to the source material we reviewed, the two absolute linchpins for unlocking that potential value seem to be: 1, successfully executing on optimizing working capital, really getting those inventory and receivable days down.
Cash.
And 2, effectively managing and scaling up that ambitious export business. Those seem to be the key factors the analysis points to.
That gives us a really comprehensive picture based on these sources. So thinking about everything we've just discussed, the strategy, the numbers, the massive growth plans, but also the clear risks, it leads to a final thought for you, the listener. What do you think is the single most critical factor for Sky Gold Diamonds Ltd to actually hit that ambitious 7,600 crore revenue target by FY27.
Yeah, something to chew on after hearing all the details from these reports.
Well, thanks for joining us for this deep dive into the source material on Sky Gold and Diamonds Ltd.